Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 8:50 a.m. Mountain Time on Monday morning, October 13th, Columbus Day. Treasury market is closed, but stock market is open. We used to joke about it back in the Lehman equity derivative days that when the negative bond guys were away, the equity market optimistic guys would play, and we tended to rally on these days. We are rallying today, but that's not exactly the circumstances. I apologize for the late publication of the note this morning and the delayed release of this video and audio summary of the note. We had a 16-hour odyssey from Wilmington, North Carolina to Vail yesterday as the Eisenhower Tunnel was closed for about 14 hours yesterday because of a fatal truck accident on the other side down by Silverthorne. So it was quite a trip home. Our note this week was titled Capital Account Rebalancing. And we were getting a lot of questions. There was a lot of discussion about gold last week after it breached $4,000. And we decided to take that on from a little broader perspective than the typical, press, dollar debasement, unsustainable debt, and inflation perspectives. I think there's a grain of truth to all of those explanations or attributions for why gold has been going up. But we think the story is broader than that. And I'll explain in a minute. We began the note, though, with a section we titled A Nasty Reminder. We were playing golf on Friday afternoon when President Trump launched the Truth Social salvo and the latest salvo in the U.S.-Chinese trade war, and the market plunged. So we weren't closely aligned to the screens, but we viewed that as a nasty reminder of what the trade war means for the economy over time. And despite all the Fed speakers that continue down this path of it's going to cause inflation to rise over time, it's just not what the markets believe. And the effect is so persistent, I just don't understand how Fed officials can continue to espouse that nonsense, quite frankly. What happened on Friday was economically sensitive equity sectors got smoked. Credit spreads widened. Treasuries rallied. The break-even inflation component went down, but the bulk of the rally was in the real rate or more growth-sensitive part of yields, which is the clear message. And the chart we put in the weekly showed what happened to the 2s10s break even and 2s10s real rate curves after Liberation Day. We had this deep inversion of the inflation curve as the markets viewed any inflationary impact as being transitory and growth likely to take a hit in the near term. And so that's what the tariffs really do, is they slow growth, and that's the bigger, broader effect. And if you forgot about it, Friday should have been your reminder. Now, moving on to this whole rebalancing idea, and as I said, dollar debasement, inflation, unsustainable U.S. debt, those are all reasons for gold to go up and may very well be contributing factors in the buyers of gold. But for us, the story runs a lot deeper than that. And we're drawn back to the 1971 to 73 analog when the U.S. first started running current account deficits in the aftermath of World War II. Gold had been getting steadily drained out of the system. The dollar gold standard was breaking down. Nixon had his 3 days of Camp David, which, by the way, was a pretty good book if you haven't read it, and decided to implement 10% global tariffs, end gold convertibility. Ultimately, Bretton Woods did fall apart as a consequence of those developments. It occurred in part because Germany and Japan, which had been rebuilt, refused to revalue their currency and try to mitigate or offset their growing current account surpluses or trade surpluses, and the U.S. surplus kept getting bigger and bigger. So that's the basis for all this. The trade deficit did stabilize for a time during the 70s. It actually, the trade deficit shrank fairly sharply for a period and then widened again in the middle 80s. The Plaza Accord made some progress on that front, but now it's bigger than ever. And so we're going through this whole global rebalancing. And within that construct, buying treasuries as your reserve asset to try and keep your exchange rate suppressed or depressed doesn't make as much sense as it once did, and you won't have the surplus necessarily. Let's say if you're China in U.S. dollars that you once had. Of course, your alternative, and you saw the Chinese. You may have seen the Chinese trade numbers last night that showed, pardon me, a big decline in their trade. Their exports to the U.S., but an increase in their exports to Europe. So they're trying to divert it, and some of it's transshipments, but some of it is just trying to sell their excess capacity to Europe that they used to sell to the U.S. The European bond markets are a poor substitute for the U.S. Treasury market. There is no European bond market. You've got to buy Bunds, you've got to buy oats, French bonds, you've got to buy BTPs, Spanish bond or Italian bonds, Bonos, Spanish bonds. They're all sort of fragmented, illiquid, and not a great alternative. Within that construct, we can see gold being a decent alternative as a store of wealth for sovereign wealth funds. Ultimately, though, the real determination of whether gold is in a longer-term sustainable rally will be as if the U.S. has any success in shrinking its current account and trade deficit. One other important element of what we wrote this week was we believe we'll never receive confirmation for obvious reasons. They would not want to destabilize the dollar, as was the case prior to the crash of '87. But we believe that exchange rates are integral to the trade negotiations that are taking place. Given Scott Bessen's background as a currency trader, we view the shock spike higher in the Taiwan dollar is a little bit of a canary in the coal mine, sort of supporting our thesis that the reason that the dollar fell in the aftermath of Liberation Day, as opposed to what happened in 2018 and 2019 when it rose, and when after President Trump enacted a 10% tariff on China and virtually offset the entire move, was Treasury Secretary Bessen's role in all this and telling them, don't go, manipulating your currency to try and offset these tariffs. It's not going to work. We'll just raise the tariffs further. So all these things are dynamics. And to me, ultimately, the path for gold does depend on whether the U.S. truly is successful in shrinking their deficit and whether China and other export-dependent mercantilist economies ultimately move away from their export dependency, and those imbalances start to shrink, and countries take a different approach. Now, a number of people were dunking on Bitcoin because it flash crashed on Friday, and clearly Bitcoin can't replace gold and sovereign wealth funds. But I think around emerging markets, and if you read Rogoff's book, Our Dollar, Your Problem, and you saw all the chaos that's occurred in emerging market currencies during the so-called free float era in the aftermath of the breakup of Bretton Woods, it's an interesting alternative for some countries, particularly if you don't have strong trade with the U.S. or diplomatic ties. The Wall Street Journal keeps recommending that Argentina dollarize. That may work for Argentina, but it's not clear that all emerging market countries want to do that. And Bitcoin might be a better alternative than gold in some cases. So I'm not ready to throw that idea away. People that are just dismissing it out of hand, we think, are being a little bit closed-minded about all this. So moving on to the economy, we note that if you will, private credit ETF, BDC ETF, BIZD, was under a lot of pressure last week. It's been under a lot of pressure over the last month. We view it as another sign that the domestic economy is weak, and the relative resilience of credit spreads, the IG CDX or the high yield CDX, is misleading because of the net supply dynamics that have made those credit spreads tighter. But a lot of that credit now resides in private credit firms. And this could be something of a sign that the domestic economy really is quite weak. We note that the Bloomberg daily retail sales transactions data is getting weaker and weaker. It's down to close to zero now on an annualized growth rate from 2.5% in the middle of August. And then we started digging in on the gross output data. Unfortunately, we don't really get this data on a timely basis. So it includes intermediate transactions, business to business transactions. And we went through it in the note, and you could see through the second quarter, things were decidedly weak. It would appear that things didn't get much better in the third quarter either, if you view Fastenal's results this morning as a little bit of a leading indicator to gross output, right? It's manufacturing parts and fasteners and all this other stuff that goes into manufacturing. And they don't have pricing power. They haven't had it for 2 quarters. And business just isn't all that good. There's some activity there, but at a lower price, which underscores our view on inflation, that you can't pass inflation tariffs through if you don't have any pricing power. You don't have pricing power because government spending is slowing, another issue that we took on in the note, and monetary policy is restrictive for floating rate borrowers, i.e. private credit companies who have issued floating rate debt to not exactly Gen AI boom type companies. So we then kind of move on to financial earnings and discuss again our views on return on equity. Our longstanding idea has been above 10% ROE. Banks earn out their cost of equity capital. That allows them to grow assets, build capital quickly, and really good for stock prices and really good for credit creation through the economy. We're still some distance from that for the smaller regional banks. We looked at the Fed H8 data through the quarter, and what you see is big banks did start accumulating securities quite rapidly, at a fairly rapid rate anyway, 8+% during the third quarter annualized. But when you look at C&I loans for small banks, they've just been dead in the water, no growth since the Silicon Valley regional bank crisis back in March of 2023. We need that ROE to get above 10% for those regional banks. That may happen next quarter if the Fed follows through with the rate cuts, as the market certainly thinks they will do, and we do as well. But that's the outlook going into this quarter's numbers. So the numbers for big banks should be good. The numbers for smaller banks somewhat disappointing, but the next quarter could be really good for the smaller banks, which we think has the better risk-reward opportunity over time. We wrap the note up with a couple of thoughts about the 5 finalists for Fed chair, and we have a very strong point of view that given the Fed's portfolio, the duration of the Fed's portfolio, the excessive amount of federal government debt, the need for the Fed and Treasury to work together, we absolutely unequivocally need capital markets expertise at the FOMC, and in this case, probably at the Fed chair. So that makes 2 of the 5 candidates, in our view, more viable than the other 3. You don't need a rocket scientist to know which ones have the capital markets experience. One of them's been hanging out with Stan Druckenmiller for the last, 12, 13 years or so, used to be on the Fed board, and another one's a former colleague of ours. So you can work that through. So that's it for me this week. The market, we think, will bounce back from this tariff threat. But it is a reminder that underlying growth is fairly weak, and we really do need the Fed to ease policy fairly aggressively to start rebalancing growth. This is it for this week. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.